today we're going to cover the two different ways banks calculate weekly and fortnightly repayments, when the safe thousands theory actually works and when it doesn't, and how to decide what repayment frequency makes the most sense for you. So let's jump into it. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Welcome back to First Home Unlocked. It's an exciting one today because we have Chris back in the studio. How have you been, Chris?
I've been well, Jack. Yeah, it has been a few episodes. You've sort of went around the grounds and went state by state. And I got sick there for our last episode. You had to sort of hold the fort. But no, I've been well. Went on a holiday. I think it was the last time we chatted all the way back in August. That was awesome. It was a real recharge. We went to Europe with the family and saw my family in Liverpool. I went to the south of France. So that was good. But yeah, November now, Jack. And what a lot of change in the first home buyer space since October 1. Obviously, the 5% deposit scheme has really changed the market, really, and changed the opportunity for a lot of first home buyers, which yeah, I'm excited about because it helps first home buyers. A little bit of a challenge with it because it does also create a lot of demand in a short space of time. And we can already see that starting to increase prices. But yeah, how have you been, Jack?
Yeah, good. And like you said, Chris, a lot has happened since October 1st. I've been busy helping a lot of first home buyers coming back and making plans or reaching out to see how that change would affect their situation. And like you said, it is an increasing market at the moment. So it's really helping them clients through making them decisions, going back to their goals and their visions and how that would work for them, and then using that scheme as a tool to get into that potential property that they weren't able to get in using the old rules after the property price increases. So yeah, it's been a busy couple of months, but I'm glad that we're back here in the studio today. And today we're going to continue our Finance 101 series that we started last week. And if you missed last week's episode, Unlocking How Your Mortgage Actually Works, make sure you jump back in and listen to that one. It's got a good overview of all the different parts of your mortgage and how they all work together. But in this week's episode, we're going to be unpacking a really common claim you'll see all over social media. And that is if you switch your mortgage repayments from monthly to fortnightly or to weekly, you will save thousands in interest and shave years off your loan. Now, it's an idea that sounds simple and smart, but it's not always true. It completely depends on how your bank actually calculates your repayments. So today, we're going to cover the two different ways banks calculate weekly and fortnightly repayments, when the safe thousands theory actually works and when it doesn't, and how to decide what repayment frequency makes the most sense for you. So let's jump into it. Now, if you have ever scrolled through finance content online, you've probably seen the claim somewhere. If you switch to fortnightly repayments, you'll pay your home loan off faster. And in some cases, that's true, but it's not always the case with a lot of lenders today. As I mentioned, the difference all comes down to one thing: the calculation method your lender uses. So when banks calculate the repayments you need to make, the standard approach is to calculate monthly repayments. However, you do have the option at most banks to make weekly or fortnightly repayments if you choose. So there are two methods used by banks to convert that monthly repayment figure to weekly or fortnightly repayments. And the impact between both is completely different depending on the bank's method. Let's start with the method used in the social media videos. So this method is called the half monthly repayment method. And this is the one that can actually reduce your interest and help you pay off your loan faster. The lender simply divides your monthly repayment by 2 for fortnightly or by 4 for weekly repayments. And that means over a full year, you end up making more total repayments compared to if you paid monthly. And that's where the savings actually come from. So let's use the same example as we did last week to break this down. An $800,000 purchase using the 5% deposit scheme. So you would have paid a $40,000 loan deposit. That leaves you with a loan amount of $760,000. We'll base it off a 5.45% interest rate to repay over 30 years. Now, under this scenario, your monthly repayment would be $4,291. Now, under the half monthly method, your monthly repayment is simply divided in half. So your fortnightly repayment would be $2,146. So here's how it works. If you make monthly repayments, you're making 12 payments per year. But if you switch to fortnightly, you'll make 26 half payments, which is the same as 13 full monthly repayments. So just by changing your repayment frequency using this method, you're effectively sneaking in one extra month's repayment every year without really noticing it. And that's what actually creates the saving, not because you're paying more often, but because you're paying more in total each year. Now, this is where that save thousands in interest message you see online actually comes from, but it only applies when your lender uses the half monthly method. So in the example, by switching to fortnightly repayments, you could pay off your loan about 5 years earlier and save $155,000 in interest compared to monthly repayments. So you can see it does make a huge impact. So Chris, what do you think? Have you seen videos online talking about this method and the savings that people can potentially have?
Yeah, I think this is where a lot of these videos come from, is that a lot of people believe that you pay the mortgage off on the bank's terms, not on what your terms are. And that's the reality, right? Yes, a bank wants you to pay this off nice and slow over 30 years, but that's just your minimum repayment that you should be aiming for. How fast you want to pay your mortgage off is really up to you. And so if you want to put more pressure on yourself to pay your mortgage off faster, you could say, well, yeah, I'm going to switch to fortnightly, or I'm going to switch to, for example, weekly. But what you could also do to just call the lender up and say, well, I want to just change my minimum repayment to, if it's $4,000 a month, I'm just going to put $5,000 a month into my mortgage. And so I think what you should always look at is the bank's minimum repayment is really the minimum. And what you want to do is look at your personal situation and say, well, okay, our combined income is $10,000 a month. The bank wants us to pay $4,000 a month, but we only need $3,000 a month to live. Well, we're going to pay $7,000 a month off our mortgage. And so I think what you really need is to have that your number. And obviously that's got to be higher than the bank number. And the higher your number can be, the better, because the reality is with home loans, interest is non-deductible and it's really quite expensive. And so every dollar you can save is really saving you interest, not just today, but it allows you to sort of get this snowballing effect. And then next year you're going to pay less interest. And then next year you're going to keep paying less interest. And you really get on top of your mortgage and smash it down. And so I think a good way to think about it is to really reframe it and go, well, my 30-year repayment is X. If I wanted to pay it off over 15 years, what repayment would I have to pay? Now, not saying you should only buy a property you can pay off in 15 years, but it starts to give you an idea of how much extra you want to pay off your mortgage to get really ahead of it.
That's right, Chris. It's good to look at them figures and what it would actually look like to pay it off in that shorter loan term. You can still pay the monthly minimum when you need to, when life happens and changes happen and you have to, but you can also make them extra repayments. Now, one final thing, and we'll go deeper into this when we cover offset and redraw in the coming weeks. The interest saving only applies if those extra repayments are coming from new money you're putting into the loan. Let's say, for example, your income is paid into and already sits in your offset and it's going to stay there for the life of the loan, then you're already getting that same interest saving benefit without needing to make the extra repayment. So we will dive into that a bit deeper in the coming weeks. Now, Chris, as I just mentioned, there's quite a few layers to this. There's that money psychology piece that comes into play as well when you're talking offset and redraw. And I'm excited to chat about that in the next couple of weeks with you. Now, a lot of lenders today actually use a different approach called the actual method. It's also the default used in calculators like on the Money Smart website. Now, this method calculates the true minimum repayment needed so your loan finishes exactly at the end of its term, not sooner, not later. So under this method, your bank works out your repayments, so the total amount you pay across the year is exactly the same, whether you choose monthly, fortnightly, or weekly repayments. Let's keep using the same example, $760,000 loan at a 5.45% interest rate over 30 years. Now, if your monthly repayment is $4,291, the bank multiplies that by 12 months to get your annual repayment, which is $51,492 for the year. Now, if you wanted fortnightly repayments using this method, the lender divides your annual total by 26, giving a repayment of $1,980 per fortnight. So you still are paying around that $51,000 for the year. It's just split across 26 smaller repayments. So your loan term and interest paid won't change. It's the same total amount, just spread differently. And that is what is known as the actual method. You'll pay less per fortnight under this method compared to the half monthly method, but it doesn't reduce your interest or your loan term. Now, there's no universal rule for how lenders calculate weekly or fortnightly repayments. Some of them use the half monthly method, which can save you interest and time. Others use the actual method, which doesn't. So you don't usually get to choose which method is used. It's built into each lender's repayment system. And in some cases, if a lender uses the actual method and you make fortnightly repayments, you could actually fall slightly behind and be classed as having missed a repayment due to timing issues. So before you make any changes, it's worth checking with your lender or your broker to confirm how your repayments are calculated. Chris, why do you think lenders don't just standardize this across the board and just use the one method to calculate this?
It is a bit of a curly one, this, Jack. I mean, they do all have little tweaks to how they think about offset accounts. They have any offset accounts they've got. They've all got legacy systems, and you'd think that they'd be able to have a lot of flexibility the way that they do this. But I think the way to think about repayments, yes, we can get stuck in all these understanding exactly how they work. But I think it's like you said, a behavioral sort of psychology element to this and going, okay, it really depends on how your own sort of personal comfort level and going, do I need to force myself to potentially save a little bit harder? Or do I trust myself to leave money in an offset account or redraw and able to not get sticky fingers? And I think this is where I think you really should just be real with yourself and go, look, yeah, I think I really will struggle. If that money's in my bank account, I'm going to then go and spend it on lifestyle spending and discretionary spending, things that I don't really need to spend money on, whether it's consumer stuff or whether it's holidays or whether it's just buying things. And if that's where you're at, that's okay. Like, let's just be real with that. Maybe you should just slowly keep increasing how much you just pay every month off your mortgage and start at the minimum repayment and just increase it every month, regardless. Or if rates go down, don't look at if your repayment changes and goes down, then keep it at the level. I think that's what people did really well in COVID. A lot of people misunderstood that even though interest rates went down, a lot of people just kept paying the repayments on a much higher interest rate. And so when tougher times came and higher interest rates, they were well ahead of their mortgage. So yeah, that's what I thought with the bank situation, Jack, is that a lot of them are on legacy systems. A lot of them have got old contracts, and sometimes they do things that are probably not in the customer's interests as well. They want to keep slowing down how long you take to pay off your loan.
Yeah, and that's right, Chris. It all comes back to yourself as an individual or a couple, what suits your lifestyle. And for example, if the bank that you're working with uses that actual method and you like the idea of that half monthly strategy, you can absolutely do it yourself, like you mentioned, Chris. You can set up the monthly repayments with your lender, then take your minimum monthly repayment, divide that by 2 and set up an automatic transfer for that amount every fortnight. And that effectively mimics that half monthly repayment method, and you'll make one extra repayment per year and save interest over time. So just make sure that you're still meeting that minimum monthly requirement, like you mentioned, Chris, and the lender should have no issues. Just to go into that a bit further, so my take on this is for most people actually prefer monthly repayments. Now, this is because you're paying the true minimum repayment with no confusion about the calculation methods, and it gives you more cash flow flexibility. You can choose when to make extra repayments instead of being locked in to do it every fortnight. Now, if your goal is to pay down your loan faster, you can still use the extra repayment strategies with your offset and your redraw accounts, but you're not locked in. That flexibility does matter, especially when life changes. For example, if you start a family. Chris, which repayment frequency do you prefer out of the 3 choices?
Absolutely, I believe in going monthly, but I do know that everyone's got different situations, and sometimes putting a bit of extra pressure on yourself to go fortnightly or weekly is just better to manage the cash flow. And I think it comes down to the individual. But ultimately, what you really want to do is try to minimize the amount of interest you pay. And the way you do that is maximize the amount you've either got in your offset account or you paid off your loan in redraw and as fast as you can. So when your money comes in each month, whether you get paid weekly, fortnightly, monthly, you want to try to get that money or the bulk of that money to sit in an offset account. Now, maybe, and often this is what I personally do, is I don't run my day-to-day spending out of my offset account. It's in looking at a big number, or say it's a huge number, but just looking at a number in your offset account isn't really the right thing from a behavioral point of view. What I personally do is transfer to an ING account where I have my day-to-day spending, and then every time that account runs out, I just top it up. So I leave the vast majority of my money in the offset account, And then I just top up my ING account with $2,000 here, $3,000 here, whatever it might be for day-to-day spending. And that means pretty much all our money is working in the offset account, and just a $2,000-$3,000 sort of running balance is not working for us in an ING account. And it really allows us to sort of just keep track using our day-to-day spending at ING, for example. And then it means that if we have to have flexibility with our home loan, we easily can. We could refinance that loan somewhere else very easily, because it's just as simple as refinancing, setting up a new offset account, and all that comes out of that offset account is the repayment. So it allows us to be much more flexible with our home loan as well.
We have spoken about these extra repayments and paying down your loan if you own it as your owner-occupied or you're living in your first home. Now, for anyone buying their first home as an investment, it's also worth knowing that the interest portion of your repayments is tax deductible. So paying down your loan faster might not always be the best strategy from a tax perspective. So you'd want to chat with your accountant and your broker in regards to that. And like you said, Chris, at the end of the day, the best repayment setup is the one that fits your situation and goals, not just what people are saying looks good online. So to recap this episode, there are two main ways lenders calculate weekly and fortnightly repayments: the half monthly method and the actual method. Now, only the half monthly method creates them real savings, because you're effectively making one extra month's repayment each year. And that's what shortens your loan term and reduces your interest that you pay. Under the actual method, your total annual repayments stay the same. So paying fortnightly or weekly won't make a difference. It just spreads your repayments out differently. Now, not all banks use the same system, and you usually don't get to choose. So monthly repayments offer that flexibility and control, and you can always pay extra when it suits you, like we've spoken about. Now, if you're not sure still how your lender calculates your repayments, you can check with your broker or your bank directly. And if you'd like help reviewing your home loan structure or planning your repayment strategy, you can book a get-to-know-you chat at firsthomeunlocked.com.au/book, or use the link in the show notes. Thank you so much for listening, and we'll see you on First Home Unlocked next week. Thanks, Chris.
Thanks so much.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know, so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes, or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.